What's up everybody, Jaspreet Singh here, and on July 13th, next Wednesday, we are going to get our next CPI or inflation report, and you want to pay attention to this and the things that happened prior to that, because what this new inflation report tells us is going to dictate what the Fed is going to do when it comes to interest rates, and that's going to affect the stock market, the crypto market, the housing market, the mortgage market, and all things in our economy. Now, in addition to that, we also got a new jobs report out today, which said that the job market last month was better than expected. We added more jobs than expected. However, there's a caveat with that because there's also some risks that come with this higher job market. So today, what I want to do right now, I'm making this video before we go into the weekend, is I want to go over what's going on with the inflation report, what you want to be aware of, and then I want to talk about the jobs report. And then I want to talk about what could happen if the Fed changes their course, because now we have traders. Bloomberg just released a report on this, that traders in the markets are betting their money that the Fed is going to now start cutting their interest rates in the near future. How that's going to affect the economy, and then I'm going to end it off by talking about the things you need to be aware of and what you need to be doing right now. So let's start by talking about the inflation report happening next week. Now, first things first. Do not try to trade the inflation report. That's not what I'm trying to talk about here. I'm not a trader. I'm not advocating you to be a trader. I want you to be a long-term fundamental investor, but I want you to understand what to pay attention to, because the inflation report is going to have a big impact on what's going to happen with the economy and interest rates. So in the last inflation report, we have seen the highest inflation yet since 1981. Now, there's a lot of varying opinions. Are we going to see higher inflation? Are we going to see the same inflation? Are we going to see inflation cooling? That doesn't really matter too much on a day-to-day basis, because the reality is still to this day, inflation is extremely high. And when you have this extremely high inflation, you're going to see up and lower inflation. And so these little swings don't really matter too much, but what you want to pay attention to is really where inflation is going and how bad inflation is, because that's going to dictate the Fed's policies. So what I mean by that is the Federal Reserve Bank is in charge of trying to control inflation. And the way that they do that is by changing interest rates. When inflation is high, the Fed is going to raise interest rates to bring inflation down. When you raise interest rates, that makes borrowing money more expensive. That makes housing more expensive. It brings stock prices lower. It brings crypto prices lower. So raising interest rates affect the markets and affects the economy, because it also makes doing business more expensive, because now if you wanted to borrow money to invest in a new facility, a new manufacturing plant, it costs more money to do that. So that's why you want to pay attention to what the CPI report says, because now what the Federal Reserve Bank is going to do is they're going to weigh inflation versus the economy. And based off of that, they're going to make a decision on what they want to do with interest rates. So on one hand, inflation is extremely high. We still have some of the highest inflation ever. And on the other hand, think of it like a balancing beam. On the other end, you have the economy. Now today, we're seeing the economy slow down, but there's many different aspects to the economy. You have business profits, you have unemployment. And one of the factors that the Fed loves to look at is unemployment. And according to their numbers, now of course these numbers are kind of skewed, but according to the reported numbers, unemployment is at some of the lowest levels ever. So when you have low unemployment with high inflation, this gives more fuel to the Fed to say, we're going to keep raising interest rates. But if you keep raising interest rates, there is a cost to that. Like I just talked about, buying a home now becomes more expensive. It becomes more expensive to do business. It hurts stock prices. It hurts crypto prices. So you see the economy slow down. When the economy slows down, that causes then the employment market, the unemployment market to change too. It causes more people to lose their jobs. It causes unemployment to go up. So this is why you want to pay attention to this, which brings me to the jobs market and the jobs report that just came out. Now, of course, we talked about this in market briefs. If you have not subscribed to market briefs yet, I highly recommend you do that. It's an easy way for you to stay up to date on what's happening in the top finance and business news. The best way for you to stay up to date on what's happening is for you to read the actual press releases, read the actual reports, listen to what the Fed is saying, read the minutes. Now, if you don't have the time, or the inclination to spend the time to do all that, then the next best thing is to join Market Briefs. It is a free financial newsletter that I created where my team breaks down what's happening in the top finance and business news, from the stock market to the real estate market to the crypto market to inflation to the global economy. It's a free newsletter. You can read it in less than 5 minutes every morning. It's witty, it's entertaining, and it's easy to read. So if you want to join Market Briefs for free, I'll put the link to how you can do it down in the description below. So if I go to this jobs report, I'm just pulling this up right here on Market Watch. What it says is that the United States added 372,000 jobs last month, which is great because Wall Street expected 250,000 jobs to be added. So we added way more jobs than anticipated, which is a good thing on the economy side because more people have jobs. But there is a caveat to that. So there's two actual caveats. The one that they talked about in this Market Briefs article is essentially they said that we can't fully trust this data because this data is doing a poll, a survey of business owners, and they're talking about how many jobs that they added because they said that there was a second poll that was done to people at their homes, homeowners talking to people. And what that poll came up with is that more people have lost their jobs. So the article talks about how you got to take that data with a grain of salt. Now, the second thing that I want to talk about is how this plays a part with what the Federal Reserve Bank is going to do. Because like I was saying a second ago, the Fed is looking at this hot employment market and they're saying this is a problem. And the problem is that when everybody has jobs, when people have all these jobs, that it's causing wages to go up, then that is causing inflation to get worse. This is what the Federal Reserve Bank has been saying. And I made a couple of videos talking about this because it might not make a lot of sense, but they're saying that right now they want to cool down this raging hot employment market. I'll actually read you word for word what they said in this article. It says the Federal Reserve Bank is sharply raising interest rates to cool off a scorching labor market and tame inflation. So just think about that for a second. What does it mean to cool off a scorching labor market? Well, if the labor market is hot, meaning people have jobs, meaning wages are going up, if they want to cool that down, that means they want wages to go down and they want people to lose their jobs. And the reason that they want that is because that's going to help bring inflation down on one end, because when you have wages constantly keep going up, that increases the costs for businesses, and that then makes people want more money as well. So it creates this wage price spiral that the Federal Reserve Bank is trying to break and trying to prevent by raising interest rates. So this is why you want to pay attention to the jobs report, because on one end, it's great news that people are getting jobs and that wages are going up. But on the second end, it's more fuel for the Fed to then raise interest rates because they have that balance beam, inflation and the economy. Right now, inflation is the thing that's weighing down the Fed, and their number one goal, this is what they say right now, is to bring inflation down, which means they're going to keep raising interest rates to bring inflation down, and that has the effect on the housing market, the stock market, the crypto market, and the economy. It brings all of these assets and factors down. Now, it doesn't always have to. If you have a robust stock market, if you have a robust asset market, and this is growing faster than the growth in interest rates, meaning the economy is growing faster than the growth in interest rates, then the higher interest rates don't have to hurt every asset class. However, that's not the economy that we're in right now. We built this bubble economy over the last couple of years through the cheap interest rates, through the quantitative easing, and now as we raise interest rates, it causes all these slowdowns in the asset prices, which is why you want to pay attention to this. And this brings me to now, what if the Fed changes their mind? And this is what now Bloomberg did a report on, because what Bloomberg said was they looked at what a lot of traders were doing in the market. And a lot of traders are now pricing in the fact that they believe that the Fed is going to start cutting interest rates in the near future. Now, this is kind of a big change from everything that I just talked about, because I just said, hey, inflation is high, the unemployment market is low. And so if people have jobs and inflation is high, the Fed's going to want to keep raising interest rates to cool down inflation. So why are they thinking the opposite? Well, what these traders are now pricing in is a recession. And once we see this recession, what they're saying essentially is that the Fed doesn't have the backbone to continue raising interest rates to fight inflation. So what a lot of people, traders are betting now, and this is not just regular people, we're talking about also institutions. They're betting that once the Fed keeps raising interest rates, it's going to hurt the stock market more in the short term. It's going to hurt the economy in the short term. It's going to cause more layoffs in the short term. It's going to cause more economic pain in the short term. It's going to hurt the housing market in the short term. But then what's going to happen is the Fed is going to say, oh no, people are losing their jobs. We're in a recession. The economy is slowing down and inflation has come down a little bit. Now we need to ignore the inflation problem and we need to focus in on the economy. So this is what traders are now betting. And based off of that, they're now buying because they think that the Fed is going to change their mind. Now, this is just something for you to be aware of because we don't know what the Federal Reserve Bank is going to do. We don't know if the Fed is going to stay true on their fight to bring inflation down because the Fed right now says that the number one goal is to bring inflation down. But is it going to stay that case in 6 months or a year? We don't know. This is where you have to understand how the system works because if the Fed starts cutting interest rates, well, then you can bet that that's going to cause asset prices to do the opposite. It's going to build a bigger bubble. You're kicking the can down the road because the inflation problem didn't get solved. The actual economic strength didn't get solved, but you're just trying to inflate the bubble because we don't want to see any pain right now. We don't want to go through the layoffs. Now, this is not a good thing because we have a real inflation problem. We have a real economic problem. And you want to solve it sooner rather than later because the more you inflate it, the bigger the problem gets, the bigger the bubble gets. And this is why you want to take care of the problem sooner rather than later. But we don't know what the Federal Reserve Bank is going to do. If the Fed stays true on their fight to bring inflation down, even if the economy slows down, even if layoffs happen, even if more people lose their jobs, well, you can bet that that's going to make the recession worse. That's going to hurt the economy more. That's going to hurt asset prices more, which creates opportunity for you to come in and buy at a discounted price. However, if the Fed changes their mind and they say, you know what, we want to focus in on the economy, not inflation, well, then that's going to push asset prices higher. This is where now, what do? Well, you can't perfectly time the market and nobody can time and predict what the Fed is going to do. So on one end, you can create a passive strategy where now you're investing your money into whatever assets that you believe in, stocks. There are ways for you to get exposure to real estate. Maybe it's cryptocurrency, maybe it's some physical gold, maybe you're buying businesses, although you probably can't do that passively. But you create a passive strategy, let's just say in the stock market, where now every week you're investing some more money into the ETFs or companies or stocks that you want to own. And somebody left me a question asking, is it better to do this once a week or once every month? And my recommendation, again, I'm not a financial advisor, I'm just a random guy on YouTube, but my tip would be to do it every week because that way you get more of that dollar cost averaging because you can see a lot of price fluctuations over that month. So, but it really doesn't matter. You can pick your own, whatever average you want to do. But you can pick every week, every 2 weeks, every month. But now you just keep buying more. That way, whether the market's up or down, you just keep buying and accumulating shares. Then on the active side, if you have an investment that you like, that you want to own, and you see a good buying price, meaning it's getting hit by the economy, it's getting hit by everything else going around it, but it's still a strong asset, that it still has the good fundamentals, well, that's when you want to come in and buy. Because when you have these types of volatile markets, these types of volatile economies, it creates volatility and that creates opportunity for you to come in and buy more. But you have to be willing to have the cash and then make that decision when the majority of people are running away. If you enjoyed this video and you want to see why we might be entering a once-in-a-lifetime opportunity to build wealth and what you can do to capitalize on it, I already made a video covering it and you can watch it by clicking that button right over there. Thank you for watching and as always, keep hustling. When the 2020 pandemic happened, that was when the stock market and cryptocurrency was the biggest opportunity. Next time,